Hey guys, it's that time again to go ahead and discover some new things in the market, kind of take a look at where supply and demand are impacting price. Economic law, more supply than demand, price drops, more demand than supply, price rises. And so we'll go ahead and take a look at some things in here over the next few minutes. As always, this information is for educational purposes, so don't use it for investment decisions. You can find more legal restrictions on our website. The link is provided below. Obviously, this time of year is a great time of year, one of my favorite times of year, where we get together with family and friends, enjoy good company, enjoy good food. At least I hope it's good company and good food for all of you. And I'm sure, around the table or as you guys are hanging out with family and friends, a bunch of different conversational topics will come up. Some of those probably will involve politics. Unfortunately, that's something that is a common, not that we shouldn't discuss our representative government, absolutely, but sometimes that can, fire people up. So do your best to keep your calm. Everyone's got different opinions on things, but I'm guessing North Korea will come up, maybe tax reform, maybe you'll watch a little bit of football. I'm guessing maybe you'll talk about the market and some of the record highs we're seeing. And so really we wanted to provide some information to you that you could provide that could be useful in those conversations. I'm not really going to touch too much on tax reform or North Korea or necessarily the football game because really tax reform, it's still in a proposal phase. We don't know when it's going to be passed. It could be any time between now and the end of the year. It could be in the first quarter. Whatever it is, it's highly unlikely to be retroactive for 2017. So really, there's not much to comment on there. I'm sure there's lots of different changes, and really, there's too much influx to really have a strong opinion on whether it's good or bad or here or that. I know the media likes to portray it in a certain way, which tends to drive viewership. When you think about 24-hour news, right? That's a hard gig. I don't blame those guys. If you asked me to sit around and talk about one single topic for 24 hours a day, I'd probably start, talking about silly things and making certain things up, just because, it would be entertaining to the viewers. And I think we need to keep that in perspective when we watch news. Really, we've changed in the past 3 decades from maybe getting an hour's worth of news to all-day news, and it's problematic in a way because how do you fill that much airtime with news? Same thing with North Korea. Do we think they're a threat? Yes. Do we think we have countermeasures as a country against them? Absolutely. There's also market triggers such as circuit breakers. Were North Korea to attack us, we think the market exchanges would shut down trading to protect traders. So, and so really, we're going to focus on markets and the things we're seeing. And obviously we've been at all-time highs. It's been a great market to be a part of. And, as many of our clients know, as some of you know, we've been very bullish since November of last year, just purely on data. And we use the Adaptiv system to do that. We use price, again, economic law, supply and demand. Price drives the 2 other features of the Adaptiv system. That's trend and strength. And I'll briefly go over what each of those are just so you get an idea of what we're talking about with the Adaptiv system, how we manage client assets at Client First. Quite simply, price. Here's the S&P 500. It's an index. Think about it as a basket of the U.S.'s largest 500 stocks. And we could see supply and demand taking place, right? We can see buyers pushing prices up into the 2000s and sellers pushing prices down into the mid-2000s, and this repeats over and over. We see price discovery taking place over and over again. More buying than selling, prices go up. More selling than buying, prices go down. And it's very hard to argue with price, no matter what is being, what pundits are saying on TV, price is price. It's very hard to argue against. So what do we mean by trend? So we use price and to identify trends. And so quickly covering our system, and some of you are familiar with, orange above blue or orange below blue. But really, quite frankly, the blue line here on the same chart, S&P 500, is the prior 40 weeks of information. Now, we don't use this exactly. We use something similar. We don't give away trade secrets on these videos, but this gives you a good illustrative idea of how we use the system. We use this across all assets. Here's S&P 500. The blue line is the prior 40 weeks of information. It's an average. The orange line is the prior 10 weeks of information. It's an average, and we quite simply make a rule based on all sorts of research out there that when orange is below blue, or so when the short-term trend is below the long-term trend, we're going to not have exposure to the market. What does that mean? In some instances, it might mean holding cash. That's something unique that we do. We do view cash as a position. We don't see a need to be involved with major corrections, especially when you're near or in retirement. That's kind of a big deal. You don't want to be having a drawdown or a move in your account that's minus 30 to minus 50%. That can be detrimental to your retirement plan. So quite frankly, when orange is below blue, we're going to avoid these periods in the market where supply is more than demand and volatility picks up. We don't want to be a part of this, but we can still capture major themes. When orange is above blue and the trend is up, we can participate. Similar, how the end of last year into this year, we continue to see orange above blue. As you know, we've been bullish for a while. We know that there's concerns in the market and they're valid, but the data price will change once those things become material. And we'll continue to use trend. We'll continue to use this type of data to manage. What do we talk when we talk about strength? So we talked about price, we talked about strength. We talked about price, we talked about trend. What do we mean by strength? So here's a fun, Thanksgiving dinner topic. If you guys talk finance and markets, since 2010, should you have owned Google stock or Domino's pizza stock? Kind of interesting. And when we look at both of their charts over here, they look, orange is above blue for the most part for Google for much of this period since 2010. Same thing for Domino's, orange above blue up during this period of time. And so what do? There's not much to be gained just by looking at it like this. What we do from a strength perspective is we divide the price of Domino's by the price of Google, and that gives us a ratio. And that's this chart over here on the right. That's a ratio. So Domino's stock divided by Google stock. We can also apply those moving averages, the blue and the orange lines, to this process and identify. And really, when the ratio is rising, Domino's is outperforming Google, and when the ratio is falling, Google is outperforming Domino's. And so really, since 2010, Domino's has appreciated 2,300%, and Google during that time, 238%. Now, Google's return is fantastic, 238% during that time, but I think we all agree that 2,300% is better. It's almost 10 times better in Google. So the simple answer and the scientific answer is Domino's is the better stock to have owned during that period since 2010 through now. Now, we use this across a lot of different assets. We don't just use it in the United States. We think globally about this, and we compare asset classes. So we'll do the Google Domino's Pizza comparison between, let's say, stocks and bonds, or stocks and commodities. Or we'll look at what do Japanese equities look like versus Chinese equities, or what does emerging market equities look like versus the U.S. equities. So we do this on an ongoing basis and use trend and strength to identify where is the strength in the market, where should we be positioning ourselves. So really, we think of markets. We know that within 401k plans, if you were to slice the turkey within a 401k plan, you can have your large cap fund, your mid cap fund, your small cap fund, which is perfectly fine. That just seems to be the cookie cutter approach to asset allocation within the 401k world. But we like to make sure that we're looking at things in a more complete manner. We also realize that there's more to it than just those things. We can slice it, into different sectors, right? So we can have materials, technology, healthcare, utilities, and the stocks that fall into those slices. Even this nice, delicious drumstick over here, international, we can't forget about that. Some 401k plans might have one international fund, whereas we have a diverse, here at Client First, we can invest in 25,000 different things. So how do we identify where to be? International is a space that should be looked at. Emerging markets is a place that should be looked at. But all these different sectors, and I just have a couple on here because I didn't want to overwhelm this turkey, but we do that Google Dominoes comparison with technology, and we'll compare technology to the turkey as a whole, or healthcare versus technology, and we'll find those ratios and those trends that we want to be involved in, and we want to be in the strongest things. We're going to go over in a minute what some of those strongest things are. So what are some of those areas of strength that we're seeing out there? Well, one of the obvious ones out there for us and for our clients, in full disclosure, some of these things that we talk about are positions that our clients hold. But for example, technology. Here's the Nasdaq 100. So these are your largest 100 technology stocks. So if you're comparing who owns what stocks or whatever, Nasdaq 100 are your big guys. Your Apples, your Googles, your Amazon, those type of technology companies. And for a while now, we've seen buyers pushing prices up, more demand than supply. Orange is above blue. The trend remains up. This continues to be a strong trend. And when we look at it on an absolute basis, so just by itself, this is a very healthy, strong technology move. And really, these moves like this, for example, back in June, this move from peak to trough is about minus 5%. But look how normal that is within the context of a positive trend. This is what a healthy market looks like. So we've got orange above blue. We continue to see buyers push prices up. Now, can that change? Yes, it absolutely can change. We can start to see selling re-enter the market, and we will eventually see orange drop below blue. Do we know when that happens? No, absolutely no one does. No one knows when that happens. That's why we use data. That's why we use supply and demand trends and strength to identify what should we be in and when. And when orange is below blue in this scenario, we'll protect. But technology continues to be a strong participant in the market. And what does that look like on a relative strength basis? Well, quite simply, when we do the ratio, remember that Google Dominoes comparison, when we compare the Nasdaq 100 versus the S&P 500, quite simply, it is outperforming. It is orange above blue. Price continues to move higher. We continue to see this characteristic, and we'll continue to have exposure to technology as that takes place. That's an important market dynamic to be aware of, is that really we are seeing technology across the board. Within the funds or slices of turkey, there's things like NVIDIA or Micron or Intel, or those things that are in the semiconductor space. We can take a look at that. So here's semiconductors. We can see that orange is above blue. We continue to see buyers in this market, and these are the like I said, NVIDIA, Micron, Taiwan Semiconductors, Intel, AMD. These vital instruments that are inside of all of our technology equipment, whether it's our phone, our computer, our TV, virtual reality headset, our cars, you name it. Semiconductors are in there, and this is a very healthy trend that we're seeing, this orange above blue. And what does it look like on a relative basis? On a relative basis, also the same thing. It looks great when we compare it to the S&P 500, for example. Continues to be in a positive trend, and really semiconductors overall are a bellwether for the market. When the semiconductor slice of turkey is good, the rest of the turkey is great. It's one of those bellwether areas in the market, and we'll continue to have exposure to that as long as the trend remains up like this and buying outpaces selling. And one area that's kind of struggled for a while now that we thought showed some promise here recently was energy. Energy has been in this downtrend for a little while here until recently. It looked like it was picking up. We've seen oil, for example. If we take a look at that, oil's been in this recent strength where we're seeing orange above blue recently, and buyers pushing prices above 2-year highs from the past. And obviously that has a high impact on energy, but yet we're really not seeing as much as we'd like to out of the energy sector. When we look at energy, we can say, okay, orange is above blue, but we're not seeing the same type of demand. For example, if we compare it on a relative basis versus the S&P 500, it's still in a downtrend. It was trying to show a positive trend, but it continues to struggle. So energy is one of those slices of the turkey we want nothing of. Some people really like the drumstick, some people like the wing, some people just like the breast meat. There's certain parts of the turkey right now in the marketplace, and really energy is the only one that continues to show to be hands off. While energy continues to be hands off, there continues to be other areas like internet, another slice of turkey, and within that internet slice are things like Netflix or PayPal and those types of things. And we continue to see absolute strength. And that just means more buyers and sellers pushing price up, orange above blue, the trend is up. And when we look at it on a relative basis, for example, against the S&P 500, again, we continue to see orange above blue, the trend is up. That doesn't mean there isn't some volatility in here, but that is volatility we could ignore because orange is above blue. As soon as orange is below blue in this type of environment, that's when we can protect gains that have made during the period when orange is above blue, or when the short-term trend is above the long-term trend. So we continue to see things like semiconductors, technology, internet, those types of things moving up. Meanwhile, the only parts where there's not as much is things like energy. Another asset class is bonds, and in this case, I'm using a longer duration treasury, for example, to look at. And we see orange above blue, but when we compare it, when we do that Google and Domino's comparison, that relative strength versus stocks in the U.S. overall, it continues to be orange below blue. The need for holding bonds with any type of growth account really doesn't make sense. We continue to see stocks outpace bonds on a relative strength basis. And again, we're using this system to identify where to be and where not to be. We know we shouldn't be in energy. We know we shouldn't be in bonds. And what do things look like internationally? Because really, we need to be thinking internationally. We need to be thinking globally. If we just focus on U.S. stocks, we're only really capturing or looking at 50% of possibilities. There's opportunities all across the globe. And really, a map of the globe like this, it's just a flow chart for capital. Trillions of dollars transacting across different economies. And you can see these relative strength things. When we do that Google Domino's comparison, we can see certain trends developing that we might want to take advantage of. And so we don't want to be myopic. We don't want to be just so focused on the U.S. that we miss out on. That'd be like only eating, half of the available pie that's there. I'm sure there's going to be pumpkin pie and pecan pie and all those things. We want to be looking at all our options and not skipping over things that could potentially be effective in a portfolio. So what are the things we're seeing internationally? So here's a chart of global stocks minus the U.S. So that other 50% of the pie that we're talking about, that is what this is. And we can see that and this one goes back all the way back to 2008, but we can see that mid 2016 we started to see this to change, and we see orange above blue, and that's a significant development. For a while, international really wasn't participating with the U.S. What do I mean by that? Well, let's use that Google Domino's comparison and see what did global stocks look like versus U.S. stocks. Well, look at this. It was a hot mess all the way back in 2008 until more recently. We're seeing that international starting to outperform, and the trend orange above blue, and the trend rising for being global, and that's it makes sense to have an increased international exposure within a portfolio because we're seeing orange above blue. I'm not going to get into too many spots, but for example, here's emerging markets. These are your Brazil, Russia, India, China, those type locations, equities. Here's emerging markets on an absolute basis. Early or mid last year, we saw orange above blue. We've seen buyers. There's been so much demand here. When you look back all the way to '08, it's finally surpassed the highs. And you'll hear in the media things like, "Oh, we're entering a low return environment." Well, frankly, if you look at emerging markets as an example, if you owned emerging markets back in '08 or even 2011, you earned 0%. You earned nothing but heartburn. This type of stuff, these sell-offs between now and then. So we just recently, within the last couple of months, broke to a new all-time high. There's that much buying, there's that much demand globally. So we now have global participation. And really, when we looked at emerging markets versus the United States, same theme, just a mess. This was not a place you wanted to be for very long periods of time. It did not make sense to be. So here's emerging markets versus S&P. Again, that Google Domino's comparison. When the ratio is falling, emerging markets is underperforming the United States. It doesn't make sense to be there, and we're starting to see that change. And this could be just the beginning. Obviously, we have no idea. Nobody knows what's going to happen in the market. But some of what we're seeing as far as potential changes in dynamics and in what should be happening within portfolios is this international space, emerging markets. I'm not going to give away too much. There's some other areas there too. Our clients know what those are. But this is a new development that is worth watching that could be decade-long in nature. So with orange above blue, emerging markets continues to look like a solid place to be, even in relationship to the United States. So in the end, the biggest takeaway here is that we continue to see positive market characteristics. We continue to see orange above blue. We continue to see buyers outpacing sellers. We continue to see more demand than supply. Here's the S&P 500. Here's back in 2014, 2015, more buyers than sellers, and this changes, right? This period in here, we saw more selling than buying, but we've recently broken out of that level, and we continue to see the market record new highs. And I understand the thought of, oh, this can't be good, this can't go on forever. But those two sentiments, those two thought processes are not proper in an investment plan. You have to have a plan. You got to have data. Just to say, oh, this isn't good or this doesn't make sense or some state of disbelief doesn't help manage assets in an appropriate way. By using data, we can manage emotions and stay focused on the facts at hand. And the facts at hand are price continues to make new highs. True, bear markets do start from all-time highs, but the fact remains not every all-time high is the start of a new bear market. And right now, what we're seeing from a sentiment standpoint is, and it'd be interesting to know when you're at the table or when you're visiting with friends, ask them what they think about the market. There's not many people that are euphoric about the market or thinking that this thing is going great, and it's going to continue to go great. Most people are very cautious, very trepidatious towards the whole market as a whole. Yes, it's great, it's going up, but they're afraid it's going to go down, and it may. Again, we're just going to use the data to manage. When we look at the S&P 500 here, we see orange above blue. This can change, orange can drop below blue, and we'll manage accordingly. And really, when we look internationally, if we take everything as a whole, so this is a chart of all global stocks, this is everything, we continue to see broad participation. This isn't just a U.S. story, this is a global story. And I don't know how the media is missing this, but for example, there's not one economy in the developing and developed world or emerging market world that's in a recession right now. That's the first time in about 3 decades, and the market's showing us this. It was showing us this back at the end of 2017. This move out of these lows, orange above blue, on a global scale. This is a global bull market, and it has broad participation. Could it go a lot higher? Yes. Is there a crash imminent? No. And typically when words used like crash or bubble, those are your emotional words, and always be cautious when you hear those used by pundits, because really it's meant to drive some type of sensationalism, some type of emotional reaction, when we just need to be focused on the data. Is there more demand than supply? If there is, and orange is above blue, we want to participate in those things. And when it's time to protect, we'll protect. And that's really it in a nutshell. We continue to see broad participation. We continue to see more buying than selling, and that's simple economic law, and we're going to take advantage of that. There will be a time when things correct. For example, it'd be perfectly normal to have a market correct from here down into this area here, which might be a 10% move. That would be perfectly normal within an uptrend. It doesn't mean the end of the world. It doesn't mean, for example, a 30% drop like in here. It's just a normal part of the process, kind of like climbing up a sand dune. Not every step is going to take you immediately higher. There's a process to climbing that sand dune. Same thing with markets. There's a process. You make a high, you establish a low, you make another high, you establish a low, you make another high. And these are positive characteristics. It's when we start to see things roll over and the trend change, that orange is below blue will protect assets, especially for our clients who are near in retirement. We want to protect that capital, and we're going to do so using our adaptive system. We hope you appreciated the information and insights provided in this market discovery video. Really, that's it in a nutshell, and there's so much to give thanks for during this time of year, whether it's family and friends, our loved ones, the food on the table, the roof over our heads, furnaces that work when it's cold outside. We all basically, live in castles and drive two chariots. We live in one of the greatest countries in the world, and there's just a tremendous amount to be thankful for. And obviously, we at Client First are tremendously thankful for our clients. We love what we do. We love our clients. We look forward to every time we meet with them and help them prepare for their retirement. The adaptive system and navigating uncertain markets is just one part of the puzzle. And so really, we want to wish you guys all a very happy Thanksgiving. Enjoy that time. Take a minute to pause, relax, calm your spirit, and go ahead and enjoy each other's company. From all of us at Client First, have a very blessed Thanksgiving.